Welcome to our deep dive into the evolution of Indian banking. Today, we'll explore the story behind our first banks, major institutions, groundbreaking reforms, and the monetary policy tools that keep our economy stable. Our journey begins in colonial times. The first private bank in India, the Bank of Hindustan, was established in 1770. Fast forward to the 19th century when three presidency banks were born: the Bank of Calcutta in 1806, the Bank of Bombay in 1840, and the Bank of Madras in 1843. In 1921, these three banks merged to form the Imperial Bank of India, which was later restructured as the State Bank of India after independence in 1955. A watershed moment arrived in 1969 when the government nationalized 14 banks under the leadership of Prime Minister and Finance Minister Indira Gandhi, aiming to promote financial inclusion and stability. In 1980, the nationalization wave expanded with the takeover of 6 more private banks, reshaping India's banking landscape for decades to come. Several key institutions have played pivotal roles in India's financial journey. Let's start with NABARD, the National Bank for Agriculture and Rural Development. Established on 12 July 1982 under the NABARD Act of 1981 and headquartered in Mumbai, its purpose is to promote credit flow, refinance rural banks, and spur agricultural and rural development. Next is the Mudra Bank, a cornerstone of the Pradhan Mantri Mudra Yojana, established in 2015. It supports micro, small and medium enterprises by offering mudra loans in 3 categories based on financing needs: Shishu, which are loans up to 50,000 rupees, Kishore, loans above 50,000 rupees up to 5 lakhs, and Taran, loans above 5 lakhs up to 10 lakhs. In the insurance arena, the Life Insurance Corporation of India, or LIC, was established in 1956, transforming the insurance sector with its widespread public ownership. For industrial development, the first development bank in India was the Industrial Finance Corporation of India, or IFCI, established in 1948. Complementing this, the Export-Import Bank of India, or Exim Bank, was set up on 1 April 1982 to facilitate international trade by providing export credit and financial assistance to exporters and importers. The National Pension System, or NPS, is another transformative reform. Designed as a voluntary defined contribution pension scheme, NPS offers 2 main types of accounts. First, there's Tier 1, a mandatory account with significant tax benefits but with restricted withdrawal options, crucial for long-term retirement savings. Then there's Tier 2, a voluntary account that provides greater flexibility for those seeking additional investment opportunities. The NPS has not only mobilized long-term savings for retirement, but also contributed to the growth of India's capital markets. The Reserve Bank of India uses several key tools to regulate liquidity and stabilize the economy. Let's break them down with examples. Repo rate. This is the interest rate at which the RBI lends money to commercial banks. For instance, if a bank needs to meet short-term liquidity requirements, it borrows funds at the repo rate, say at 4%. Reverse repo rate. Conversely, this is the rate at which banks deposit their excess funds with the RBI, earning them interest. If the reverse repo rate is 3.5%, banks earn that rate on their surplus balances, cash reserve ratio, or CRR. Banks must maintain a certain percentage of their deposits as cash with the RBI. For example, with a CRR of 4%, a bank holding 1 lakh rupees in deposits must park 4,000 rupees with the RBI, statutory liquidity ratio, or SLR. This requires banks to keep a percentage of their deposits in the form of liquid assets like government securities, say 18%, ensuring they have ready funds available. Open market operations, or OMO. These involve the RBI buying or selling government securities in the open market. When the RBI purchases securities, it injects liquidity in the market, and when it sells, it absorbs liquidity to manage inflation. Each of these tools plays a pivotal role in ensuring our financial system remains robust and responsive to economic changes. Over the years, several advisory committees have helped shape the reforms in India's banking sector. The Reiki Committee reviewed governance and operational efficiencies in rural banks, while the NASIMA Committee offered critical insights into risk management and reform measures in a post-liberalization era. The KELCAR Committee recommended strategies for restructuring and modernizing the banking system, and the Tandon Committee focused on asset classification and credit risk management. Their recommendations have been integral in building a resilient and dynamic banking industry. Finally, let's define a scheduled bank. These are banks included in the second schedule of the Reserve Bank of India Act, 1934. They meet specific criteria such as a minimum paid-up capital and reserves. Being a scheduled bank grants access to various benefits like RBI refinancing facilities, thus ensuring enhanced stability and credibility in the financial system. From the establishment of early banks in the 18th century to the comprehensive reforms and regulatory measures in today's dynamic system, Indian banking has come a long way. Its evolution reflects our country's journey toward financial inclusion, modernization, and global integration. Thank you for joining us on this historical and enlightening journey through the world of banking in India. Like, share, and subscribe for more deep dives into economic history and financial reforms.